Let's talk about level 2 asset protection, irrevocable trusts. The difference between an irrevocable trust and a revocable trust is a revocable or revocable trust. You can amend, change, revoke, put in assets, take assets out. An irrevocable trust cannot be amended or revoked. That's the difference. So it's kind of like set in concrete, right? You really can't change those terms. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I'm a 30-year attorney, been around for 30 years. I am a certified specialist in estate planning, trust, and probate law. Our firm has offices throughout the state of California. I'm insurance and securities licensed, as well as a pilot single engine land instrument rated, although I'm not current. So kind of a broader background, as well as a real estate broker. These are the lawyers in our firm. We are dedicated to all things peaceful transfer of wealth for individuals and business owners from one generation to the next, and maybe another generation after that. This is very important. This is a disclaimer. What does this mean? I'm going to talk, I'm going to say you. There's no attorney-client relationship. Even though I'm a lawyer and I'm saying you, there's no attorney-client relationship. Basically, don't watch this and go out and try and do a bunch of stuff on your own and think it's going to work without any hitch in the get-along. You really do need an experienced lawyer, and that's why we have many experienced lawyers in our firm to help you. So what is asset protection? What are we talking about? Who do we seek to protect? Are you thinking about protecting your assets that you own from creditors? Well, that's one type of asset protection. What about asset protection for a gift or an inheritance that you give potentially a child or another loved one? What types of threats are we talking about? It is a function of financial planning. It is designed to protect assets from creditors. That's what asset protection is. People who come together to create a business, they use certain asset protection techniques to limit creditor access to certain valuable assets. So with an irrevocable trust, you don't owe the money. If we're talking about putting money in there, you don't own the money, but you control the rule books. Who are the beneficiaries? You get to say who that is. What the money can be used for? Absolutely, you get to dictate what that is. When they get it, who the trustee is. Common examples would include a dynasty trust. A dynasty trust is a trust that holds money that can go on for one or more generations. And, there may not be distributions from this for 20, 30, 40, 50 years, but it's going to grow and grow and grow and grow. And it's going to be where ideally the growth in the estate occurs in this dynasty trust, so that when the person passes away, the assets, even if that 15 million is grown to 50 million, the assets in that trust pass free of estate tax. Okay, that's a great benefit. The trustee controls the keys to the dynasty trust, to this treasure chest. In each generation, the assets will hopefully grow, but the key to the treasure chest is always held by a responsible trustee. So special needs trust is another type of irrevocable trust. Now, this irrevocable trust is for people. This is a form of asset protection. So if you have a loved one with special needs that is receiving public assistance benefits, potentially Medi-Cal in California, not so much Medicaid, that's not as much needs-based, but they might also be getting a monthly benefit, an SSI benefit. Sometimes, in fact, in most situations, if that recipient of those benefits, those needs-based benefits, gets too much money, they lose the benefits. So it's very important. A lot of people who have loved ones with special needs will do special planning and use a special needs trust in order to protect those assets, right? To preserve the public assistance benefits. Irrevocable life insurance trust, what is that? That is a trust specifically designed for wealthier people who say, I've got a life insurance policy, and I do not want that life insurance policy taxed at 40% when I die, which is what happens if you're the owner of that policy. And so there are ways that you can save that 40% tax on the death benefit. I'm assuming you have a taxable estate at that point, which would be an estate of greater than $15 million. The Spousal Lifetime Access Trust is an irrevocable trust. There are a lot of income tax benefits and capital gains tax benefits potentially with the Spousal Lifetime Access Trust or not. It just depends if it's a grantor or non-grantor. A lot of people will create what we call a standalone special needs trust. The reason people do that is for two reasons. Number one, other family members want to make a gift to the special needs trust, so you have a single pot of money. And if your parents want to leave something to a special needs trust, that is not a standalone special needs trust. If it's inside your living trust and you're still alive, they just can't do it. The other one is if you have IRAs, retirement accounts. So that is going to be typically a standalone special needs trust. Those have very important language in there. If you have 3 children, you have one daughter with special needs, and two other children without special needs, you have $2 million in non-IRA assets and $1 million in IRA assets, you may want to leave the IRA assets to your daughter with special needs. The reason is that daughter can stretch out that IRA over her lifetime. What does that mean? When you inherit an IRA, you don't take all the money. Well, you really shouldn't take all the money out at once, but you have to take it out after 10 years, right? Under most circumstances, after 10 years after you die, you have to take all the money out. That $1 million becomes $2 million. You take all the money out of an IRA, you're going to have a really big tax bill. If you leave that IRA to a loved one with special needs, you can stretch out those minimum distributions over the lifetime of the daughter with special needs. Very, very powerful strategy. We covered that in other webinars, but I want you to know that is a tax savings strategy. It is an asset protection strategy. And I think too often lawyers don't think about special needs as an asset protection and tax strategy. So what is a special needs trust for? It's to maximize quality of life, provide money, potentially money and other kind of in-kind support without disqualifying the loved one, and to manage assets and protect from predators and waste. You want to provide for your children, but you want to do it in a way that does not cause them to lose their public assistance benefits. So that's really how that works. We have a case here. Andy's a 30-year-old man with developmental disability and supplemental security income and Medi-Cal. So Andy's parents fund a trust with $600,000 from their estate, meaning they pass away. They fund this trust after he passes away. And this includes life insurance proceeds and savings to be managed by a professional trustee. With a properly structured special needs trust, the $600,000, Andy gets to keep his public assistance benefits, and the money's used to supplement his needs. So pay for a computer, internet, online games, maybe a trip to Disneyland, for a personal care attendant, as well as provide structure to ensure that Andy's properly cared for. The number one thing, if you have a child with special needs, you know what I'm talking about. The number one thing that people are worried about, the number one concern that they come to me with is, Jim, what's going to happen to Andy when something happens to me? That's the number one concern. And so this really helps a lot. If this is you and this is of high value to you, great. And if you're like, I don't have a kid with special needs, why are you talking about this? There are, I think, 50 million people who have a disability in the United States. You probably know someone who has a child with special needs. Please share this information. There's first party and third party. I won't get that into too depth, but understand that it depends on who's creating the trust. Whether it's a third party would be the parents creating it. First party would be if somebody is receiving a personal injury settlement. The power of an irrevocable life insurance trust. So that's a mouthful. It's also called an ILIT. Why do we have irrevocable life insurance trust? We have life insurance trust because it is great that life insurance, if structured properly, is free from income tax. If you deduct your premiums, like if you have a business policy and you're deducting your premiums, that death benefit's taxable. So you probably want to double check that. Life insurance is included in the estate of a deceased person if the deceased person owns the policy during their life. I have a policy. I have several policies of life insurance. One of them that I have is a term policy of life insurance. I'm the owner. That's included in my estate. It's going to end in 5 years or whenever it's going to end. Hopefully it won't pay out. Hopefully I'll live another 5 years. But that's an example of, and I think it's really completely appropriate in most situations. If you have a term policy of life insurance, that's the cheap one, not the expensive one. If you have a term policy of life insurance, it's okay to have that in your name. When you have, and our example here, when Wanda dies, she's got $1 million death benefit, and the insurance is subject to a 40% death tax. That's $400,000 plus state inheritance taxes. We're in California, we don't have those. But if you have a larger estate, so what now we're talking about are people who, when they pass away, they have an estate of over 15 million, or they've given away a lot of it. Maybe they've given away 15 million, so everything's taxable. So if you have an estate of 2 million and a life insurance of $1 million, setting aside state inheritance tax, this is not a problem for you. But what we're talking about here is people with larger estates who want to buy life insurance to essentially pay the estate tax is what we're talking about. Now, functionally, it pays the estate tax. It doesn't directly pay it, and we'll get into that. But in order to be not included in Wanda's estate, remember Wanda, she had $1 million policy with the $400,000 death benefit. Wanda cannot own the life policy. If Wanda uses an irrevocable life insurance trust, she cannot be the trustee. That's just black letter law. That's the rule. She can, her kids can be the beneficiary. She might have a trust company or other individual be trustee. My strong preference is a trust company, because if they screw up and it ends up being included in your estate, or they don't pay the premium and it lapses, you can sue them and recover, hopefully, but hopefully they won't screw up. but it's very, very important to have a responsible person in that role. And I think best practice is to use a trust company. And the trust companies we use, essentially, you're buying a life insurance policy that they won't screw the thing up. The benefit of a life insurance trust removes life insurance proceeds from your taxable estate. This is great. So if you have a $10 million policy, instead of having a $4 million tax bill associated with that, you have a zero tax bill, right? And that $10 million can be used essentially to purchase assets from your trust estate to provide the estate cash. So for example, if you have a business that's worth $50 million and you're married, you and your spouse can exempt $30 million in estate tax, but $20 million is subject to tax. That's an $8 million tax bill. So if you're a business owner and your assets, they total $50 million, the first $30 million goes tax-free. The next $20 million is subject to a 40% tax, or $8 million. If you have a second to die policy, and we'll talk about this, of $10 million, when that pays out, there is $10 million in cash. If your business is worth $50 million, you probably don't have $8 million laying around where you can pay a tax bill, which means you're going to have a problem, right? But with this life insurance, it provides the cash in order to pay the taxes. And that's really what we're talking about here. But what you do is you set up this life insurance trust, you put money into the trust, the trustee takes out a policy of life insurance. You can contribute an existing policy of life insurance, but there's a 3-year look back period. So if you die within 3 years, it is included in your estate. And then on your death, this trust, this life insurance policy passes tax-free to the beneficiaries. You give up all control of the policy. You're not the trustee. You're not getting the money when somebody dies, and you have no access to cash value. So really what you're doing is you're prepaying estate taxes really for pennies on the dollar. So we have a little graphic here. Wanda gives annual premium payments to the life insurance trust, though in this case, and then those premium payments, that money flows to the life insurance policy flows to the life insurance company, and in exchange, Wanda's trustee of Wanda's life insurance trust gets a policy of life insurance, so that when Wanda dies, the money passes tax-free to the heirs. Basically, Wanda's trustee has to send out a letter to the kids, in this case, Wanda's kids, who are the beneficiaries of the trust, has to send out a letter every year saying, hey, mom's put $19,000 in this trust. And then mom walks the kid around the block and says, look, don't take this money out, just leave it in there. And then the kids leave it in there, and then the life insurance passes tax-free. So here's kind of an interesting stock example we're going to go through. So if you have $5 million in stock with $1 million cost basis, and it's going to be worth $15 million 20 years from now, and this assumes 6% growth, and you say, look, I'm concerned about the value of my estate. I want to use up some of my gift tax exemption. I'm concerned about capital gains taxes, but I do want to make a gift to maybe a Dynasty Trust of $5 million. So one thing you could do is you could give the stock, actually you just give the stock to the kids and say, here you go. And then they pay the tax or whatever it is, but you're taxed on that $5 million gift. They get your $1 million cost basis. So that means when they go to sell the stock, they're going to have a $4 million gain between them. You can avoid, so if you use the $5 million of your lifetime exemption, you get the future $15 million out of your estate. You're avoiding $952,000 long-term gain capital gains tax for you, but you're passing that to the kids. The kids have a $2.4 million tax liability in 20 years, right? Because I give them $1 million cost basis, and then it goes to $15 million. So I'm just kicking the can down the road, but the kids are going to have that big tax hit. So the net result after 20 years is $12.6 million. The alternative is to sell some of that stock, maybe sell half the stock, buy a life insurance policy. You end up with more money because what you're doing is you're paying your capital gains taxes now. And in the future, the kids get the death benefit on the life insurance policy, which passes tax-free. Let's talk about a spousal lifetime access trust, or the SLAT. A spousal lifetime access trust is where I create a trust for the benefit. If I'll be spouse one here, I'm the grantor, I create a spousal lifetime access trust. For spouse two, my wife, I say, here you go, honey, here's $15 million. I'm going to put $15 million in a trust. And she has lifetime access to the funds. And then when she passes away, it goes to the kids. This can be cash, life insurance, real estate, businesses, other assets. I can have no involvement with that trust, okay? However, if my wife and I go to dinner, and we go to a really nice dinner, And she says, I'll pick up the tab. I'll pick up the tab from the money I distributed to myself from the trust. So there's effectively what we call, although you're not a named beneficiary, the way it works in the real world is that indirectly your wife, in this case, once my wife has the money in her pocket, once it's distributed from the trust, she can do whatever she wants with that money. She could give it back to me, but that can't be the plan. But she can use that money to pay bills and buy trips and I suppose buy me gifts. I don't know. But the whole point of this is to set the money aside. So a spousal lifetime access trust that's funded at death is a bypass trust or a credit shelter trust or a B trust, right? So what we're doing is instead of funding this at death, we're funding it during life. This is an irrevocable trust established by the donor spouse. The remainder, whatever's left over, goes typically to the couple's children. I'm assuming that these two people have children together. If they have children from prior relationships or marriages, does that make the planning more complicated? Yes. Are people less likely to use a spousal lifetime access trust? Probably. Okay. So what is a domestic asset protection trust? It is an irrevocable trust designed to shield your assets from future creditors, not the ones you have now. Okay. While still allowing you, the person setting up, the settlor or the grantor, to be the beneficiary, get the goods, the benes from the trust. I think Nevada is one of the best. They're consistently ranked near or at the top by different people who rank these. Nevada is one of the most favorable states for using these trusts because of the strong asset protection laws. Think of a Nevada domestic asset protection trust as a legal safe deposit box for your wealth, guarded by Nevada law, but with the trustee holding the key. So you're under the protection of Nevada law. You can ask for withdrawals. You can't demand them. You can say, hey, I'd like to have some money. You can't demand it. And that's the whole point. You don't have control. Remember, whatever you can get to, your creditors can get to. So if you can ask for it and they don't have to give it to you, if you have a creditor, you're not going to ask, right? That's kind of how it works. And by the way, if you had the power to demand it, that demand right, a creditor can seize that demand right. So that's why it's an ask, not a demand. An irrevocable trust here's what you need to get your head around. This is not like a bank account where you're making deposits and withdrawals. This is the bury the money in the backyard asset reserve. Once the assets are transferred in, you generally aren't going to be taking them out. That's why it makes it viable for creditor protection. If there's money going in and out and in and out, there's a track record. It's not, first of all, your trustee is not going to let you do that because it's going to harm the efficacy of that of the entire plan. You can be a beneficiary. Unlike many states, Nevada does allow you to be both the creator and beneficiary of the trust, but not the trustee. You can still receive distributions, but only at the discretion of the independent trustee. So very, very important. Nevada has a short statute of limitations. What is this? Nevada law gives creditors only 2 years, sometimes as little as 6 months if they were already aware of the transfer, to challenge the trust. So there's this seasoning period of 2 years. This is one of the shortest windows in the entire country, and there's no state income tax. So for those of you who are accustomed to paying state income tax, there's no state income tax in Nevada. And this is particularly appealing if you're in California or New Jersey, New York, wherever it might be. You have some other issues with New York and payment of local taxes, but if it's a domestic asset protection trust, undistributed income, there's a bit of a benefit there. So how does a domestic asset protection trust work? It has a high standard of protection. Nevada does not recognize certain exception creditors like divorcing spouses or child support claimants the way some other states do. So this is unusually strong protection. I'm just telling you what Nevada law does. And how does this work in practice? You place the assets like real estate investments or cash into the trust. An independent trustee in Nevada, not you, not your spouse, not your kids, manage the trust. You can receive distribution on the trustee's approval, but you have no demand right because that demand right could be seized by a creditor. And if you get sued in the future, in most cases, the creditors cannot reach those assets once the statute of limitations has expired. So no protection from pre-existing creditors or fraudulent transfers or voidable transfers. There's no shoving money into the domestic asset protection trust after the lawsuit has been filed and expect it to disappear. IRS and state taxing authorities are not fooled by these trusts. You still have to pay federal income tax on earnings, and control is limited. If you exert too much control, it just won't work and the trust can be pierced. So Mike creates a Nevada Domestic Asset Protection Trust, names Premier Trust Company, a Nevada Trust Company as trustee. The trustee opens a Schwab account. This is kind of the flow of funds here, right? So the trustee opens a Schwab account, and Mike transfers $10 million in cash and marketable securities to Premier Trust as trustee, and then Premier puts those assets in the Schwab account. Premier's trust name is on the Schwab account as trustee of Mike's Domestic Asset Protection Trust. Mike keeps the $1 million in the trust. Mike is later sued and loses the $1 million that he kept out of the trust, but the $10 million he put in the Domestic Asset Protection Trust is protected from creditors. And I put this slide in here because Mike's not going to put 11 million into the Domestic Asset Protection Trust. He has to remain solvent, right? Having $1 million in this case solves the solvency requirement. So this is not 100% protection. It is a lot of protection, but it's also not this in and out bank account situation that the in and out of the spending and the collecting of income or whatever it is would happen on that $1 million outside of the Domestic Asset Protection Trust. Let's talk about level 3 asset protection. We're going to talk about entities. So we have a cartoon here. When I go, I plan on taking at least 2 of my estate tax lawyers with me. Pretty funny. Different types of business organizations. We have a sole proprietorship. This is just, if Jim buys a pickup truck and gets a lawnmower and charges $50 to mow a lawn and there's no organization, no, that's a sole proprietorship. Partnership, 2 people coming together, you can register it with the state. You cannot, but it takes 2 people to be in a partnership. You cannot have a partnership of 1. Corporation, these are S and if you hear S and C corporation, so S is in Sierra, C is in Charlie. What does that mean? Well, they're not different kinds of corporations. It's just the way they're taxed. So small corporations, if you're a small business owner watching this video, you're probably not going to have a C Corp, probably going to be an S Corp because that's what your CPA told you to create. A C Corp is for like Apple, NVIDIA. Those are C Corps. S Corps a lot of times are smaller corporations. So we have a law corporations, we're an S Corp. And professionals don't do C Corps because you have a flat 35% tax. It doesn't make sense to do it. LLC is a disregarded entity. An LLC can be a disregarded entity, partnership, or corporation, and an S or a C. What do all this mean? This is just tax status. LLC is the type of structure. It was created in Wyoming in 1977 for the first time in the United States. Disregarded entity means that you own all the shares of the LLC. You report all the income and expenses on your 1040, on a schedule on your 1040. A partnership files a Form 1065. It's a separate return. A corporation files an 1120, a Form 1120, and that's a separate income tax return, separate from your 1040. So that's what all those mean. Now, if I ask somebody, do you have an LLC? If somebody says I have an LLC, my next question is it a disregarded entity, partnership, or corporation? And they go, it's an LLC. It's going to be one of those. So it's different kinds of LLC when it comes to taxes. So just pay attention to that. California LLCs, we're in California, so we're going to talk about California. California LLCs offer little outside creditor protection. And what I mean by outside creditor protection is if I own shares in an LLC and somebody sues me, right? Let's say I own shares in an LLC that owns an apartment building and I get in a bad car accident and people sue me because there's not enough life insurance. That act of suing me, they can recover my assets. They can actually recover my shares of my California LLC, and they can foreclose on them in the same way that similar way that a bank can foreclose on you if you don't pay your mortgage. Okay, so that creditor can become a member of the LLC and has all sorts of rights and can close the LLC down and force a sale of the assets. So California is very, very creditor friendly. Very, owner unfriendly, frankly. So this really stinks for single member LLCs that have no other partners, right? That's an example of single member LLC. It's really hard it's really hard to prevent the complete liquidation of a company. If Alpha and Bravo put their $1 million stock portfolio into California LLC, the creditor can foreclose on Alpha and Bravo's membership interest and get the $1 million. This doesn't happen with a Wyoming close LLC, and we're going to contrast a Wyoming close LLC. So a lot of times what we do, and we've got a slide here, a holding company slide, but let's start with, and this is where we're going with this. Let's start with a Wyoming close LLC. Well, a Wyoming close LLC is just a Wyoming LLC. Close is the operating agreement. So it's not a different type of LLC. It is the way the operating agreement is written. An operating agreement for an LLC is like the bylaws for a corporation. It's the governing documents on how the LLC is to be run. If the Wyoming LLC holds the shares of a California LLC, that means that the Wyoming LLC is what we call a holding company. And the shares of the LLC, the shares of the California LLC can effectively get charging order protection. So let's look at this again. Alpha and Bravo own Greenacre, a 25-unit apartment complex. The dirt, bricks, and sticks of the apartment complex are owned by a California LLC. The shares of the California LLC are owned by the Wyoming Close LLC. Alpha and Bravo's Living Trust owns the shares of the Wyoming Close LLC. So what we've got here is this structure where we have a holding company owning shares of the LLC, not Alpha and Bravo. So A and B do not own shares of the California LLC. The Wyoming holding company does, and A and B's Living Trust owns the Wyoming holding company. And here's why this is important. Alpha and Bravo now have charging order protection from outside creditors to protect their equity in Greenacre via the Wyoming holding company. So what does this mean? This means Alpha and Bravo, they don't own the shares of the California LLC. Remember, if I own shares of the California LLC and I have outside credit, I get in a car accident, and there's a lot of creditors, those creditors can seize my shares because I'm the owner. If a Wyoming LLC owns the California shares and they go and the creditor says, okay, Cunningham, what do you have? And they're going to say, oh, you've got a California Close LLC. That creditor is limited to charging order protection. What does that mean? Charging order protection that means that, yeah, they might be able to become a member of the LLC, but they have absolutely no rights to force a sale of assets of the LLC, and they don't have a right to distribution. So if I'm not getting a distribution, they don't have a right to distribution, but they get a K-1, so they're going to get taxed, right? So if there's tax that's happening in here, if there's income tax, that creditor, once they take those shares, has no right to liquidate the LLC, but they have the tax obligation under federal law to pay the tax. It is a poison pill. This brings the creditor to the bargaining table, and in many instances, there is not a lot of case law on this because most creditors just settle. They don't want the tax liability and no ability to get the underlying assets. That is what charging order protection is. Very, very important. This benefit actually can extend to single member LLCs. So the academics say, I think you're better off with a partnership for a lot of different reasons. And that is why we oftentimes couple a holding company with the Dynasty Trust. So what we do with the Dynasty Trust, the parents manage it. Maybe the Dynasty Trust owns 10% of the holding company, maybe 30%, whatever it is. But if you have a multi-member Wyoming LLC and you've got other entities in there other than the people who are getting sued, I think it increases the argument or increases the strength of the creditor protection. So we cover this in other webinars. I would encourage you to take a look at it. This brings us to the end of our time together, and I'm glad that we got to spend so much time together. If you're watching this on YouTube, please subscribe to our YouTube channel, and please put a comment in the comments in the Q&A on the YouTube channel. And we have another webinar coming up. Check out our YouTube page, our website for our next webinar, and keep watching because another video will magically start after this one ends.